Hi, thanks so much for joining in. You're watching the Mutual Fund Show on NDTV Profit, and my name is Alex Matthew. Now, this show gets you actionable insight on everything mutual fund related, and to that end, today, I'd like to talk about something we don't speak about enough, and this is an admission. We talk about the top performing funds in any given period, but we don't talk about the underperforming funds enough. And so, we've already discussed earlier in this week the top performers in 2024. So I thought, why don't we look at two of the most popular categories in the equity actively managed space, that is the Flexicap fund as well as the sectoral and thematic funds. Sectoral and thematic, by the way, the largest category by far. And talk about the top 5 underperformers in the year gone by. Now, to be sure, take this as a statement at the start. This is not to say that these fund managers are bad in any given way. It is to say that for whatever reason, the tactic that they have followed or strategy that they have followed in the year gone by has underperformed the rest of the market. We'll talk about why that is, and we'll talk about periods of underperformance and outperformance and how that might just balance out over a period of time. We'll also talk about what your response should be if you are invested in a scheme that has been underperforming both the benchmark as well as its peers. Joining me on this conversation, I have Juza Gabajiwala, who is Director at Ventura Securities, and Suresh Sadagopan, who is Managing Director and Principal Officer at Ladder 7 Wealth Planners. Thank you so much, gentlemen, for taking the time, and wish both of you and your teams a very, very happy new year. Before we start this conversation, let me pull up the schemes on the screen so that we have some context for which we are speaking. Let's pull up the Flexicap schemes first. And the worst performer, Samco Flexicap Fund, had a return of 4.5%, and that compares with a category average of 20.3%. Navi Flexicap, Tata Flexicap, NJ Flexicap, as well as UTI Flexicap have all managed double-digit returns, but significantly below the category average. The worst performing sectoral and thematic funds are worse off in that they are all single-digit returns or less, where you have LIC Banking and Financial Fund as well as ICICI Proof FMCG Fund, which have gotten less than 1%, and they've even underperformed their benchmarks over that period of time. And ABSL, which is the 5th in the list, has managed a gain of about 7.4%. Juza, I'll come to you first on the sectoral and thematic, because I guess there's an easier way to explain the underperformance of these schemes in the year gone by. What would you say about them?
So anyway, Happy New Year to you also, Alex, and thank you for having me on the show. So actually, I think the theme is actually you are actually doing a risky play, right? I mean, first of all, you need to understand that when you are doing a sectoral or a thematic play, you are much more on the higher end of the risk. And banking and FMCG, I would actually call it more of a sectoral rather than a thematic, because you are focused only on a particular sector. And we have actually seen that the private sector banks and the public sector banks, the index itself has not done too great. So with having large concentration on only a particular sector, you are going to be having a return which could be very, very flattish, and suddenly next year it could be extremely positive. So just looking at 1 year standalone return would actually also not be very correct. So you need to, and this is more of a tactical play. So when you are into a pure sectoral type of investment, it is a high risk. So you need to be having, according to me, looking with a more of a 3-year time horizon rather than just 1 year time frame.
Okay.
That's what.
Yeah, and there will be periods of significant outperformance and underperformance of each of these themes. Understandably, that's how cycles work. I'm coming to you, Suresh, on the Flexicap funds, and this is slightly harder to explain because ultimately each of these fund managers will have had a specific thought process when they were constructing their portfolio. It just so happens that in the 12 months that we have selected, they have underperformed. What have you looked at when you looked at this list?
I agree with Juzer that this is a 1 year performance which we are really talking about at this point in time. 1 year performance is not really indicative of the long-term performance or the potential of the fund. Having said that, if we look at quickly look at some of these things, we can actually look at what probably has not worked in the strategy. One of them is in the case of Samco, it's essentially a very highly concentrated investment approach. There are just about roughly 25, 26 stocks which they have. And they have a hexa shield framework. That is how they put it. There are several filters by which actually they filter out companies, and it seems to be a very good and comprehensive strategy. But only thing is, only 15 out of 50, even the Nifty 50 companies seem to be coming into the picture as far as their investment candidates are concerned. Which means it's possible that they are missing out on good growth stories which are there among the Nifty 50, or even the other categories as well. So that probably is one of the reasons why Samco probably is underperforming. There could be multiple other reasons. There are certain sectors which would not have been properly represented. If you really look at PSU as a sector, or realty as a sector, or IT as a sector, if there is under representation of these in the various funds, then again you will have a kind of a problem. So some of that I see as far as Samco is concerned. As far as Navi is concerned, I don't see any specific problem, but it can also be a problem of when you get in, when you get out. So if I look at, let us say the portfolio of Navi, largely it seems to be okay. The same set of names which I find are winners in other portfolios are also represented in Navi. So it can very well be a case of missing out on certain sectoral themes, and also going in and out of certain companies at probably not the right time. So that seems to be one of the things. And just one more to just illustrate the point is Tata Flexi. One of the things which I find here is that exposure to PSUs seem to be low, and exposure to banks which are not really performing, like Kotak, Axis, HDFC, they have not performed that well. So high on financial in this particular case could be a reason why this has not done that very well. So there can be multiple reasons, including what is the expense ratio. Of course, the expense ratio cannot tell you an underperformance of say 6 or 7% or 10%, but it all contributes to that. So there can be multiple reasons. Having said that, all I would say as a wrap up is that one should look at a long-term play. Sometimes what fund managers do bear out in certain segments of the market, and sometimes there is a huge underperformance like this, which you see in some of these cases at certain points. So I would leave it at that.
Yeah, it's a fair point. So therefore, what should you do is the next question. If you have such schemes in your portfolio, you've seen a period of underperformance. It is unfortunately the case in more situations than not, where you have 6 or 7 schemes and 2 of them may have underperformed. But Juzer, what is an acceptable period of underperformance? And would it be an underperformance versus peers in that it's lower than the category average? Or is it underperformance of benchmark that will irk you more?
So, Alex, actually, Flexicap is a very different category, because if you try to compare one fund to another, it would actually be a little bit difficult, because I'll give an example. Like, let's take Samco. Samco has got 40% nearly allocation to mid cap and 33% to small cap, and 28 odd percent is there to large cap, as compared to most of the other guys who are nearly 50% into large cap, right? So having said that, that's not my concern, right? I have given the money to the fund manager, and he's supposed to manage the money. And in Flexicap, I'm giving him, complete freedom, whether he wants to be in small, mid, or large cap, and whether which sectors what he wants to play. So I will be, quite not very, what do you call it, forgiving. And if my returns are going to be way off the benchmark, right, I would actually exit out of the scheme. I would wait and look at a 1 year return. So, like, for example, Even though Samco Flexicap is giving me a 4.5% return and it is way off the benchmark and it's not even completed 3 years, I would actually exit out, even though my period would be short. The second thing I would also look at is that the entry point also I would be extremely selective of getting into flexi cap, right? Because if you actually go to see in this calendar year, nearly two-thirds of the schemes have actually underperformed the other broader categories. No, I'm not comparing sectoral and all that, but when you have multi-cap and large cap, small cap, so nearly two-thirds of them have actually underperformed, and top 10 schemes are actually controlling 75% of the AUM. So you should go with more of be very very selective, and you will also have to exit also reasonably faster from here, because I think 1 year is a reasonable time period for a fund manager to at least get it reasonably right. I'm not saying that he will get 100% accuracy, but he should get it reasonably right. He cannot be way off the benchmark.
It's a fair point. So review once a year is Juser's recommendation. Suresh, do you have a different opinion here?
No, I am absolutely with Juser. There are other ways by which we actually look at from a advisory standpoint. See, normally what we do is he talked about entry, right, into a particular fund. So we have certain criteria, like any fund which has completed, let us say, at least 3 years, which has shown a long-term kind of a performance metric, which is consistent. And we watch those things on a regular basis. We have our own MF rationale, and every 6 months we watch that, and we classify that as candidates which we can continue to hold, candidates which are not really doing that very great, candidates which can exit. So we have those categories. And if there is a underperformance, we would have come into that particular fund primarily because it is a consistent performer. We are fine with the way the fund is managed, the theme, the way the fund manager is managing. We are good as far as the fund manager capability is concerned. That is why we have come into the fund. If all those things are in place, we would actually give several quarters to that particular fund before actually exiting. So, but in this particular thing which you are showing, this is a kind of a polarizing table that you are showing. So, if the underperformance is of this nature, probably we may have to exit. But normally it is not exactly like this, and we tend to hold on for a few quarters before actually taking a call.
No, it's a very fair point that you're making, Suresh. And understandably, I have to choose a list of mutual funds and schemes, and we can't possibly talk about the entire market and the entire mutual fund category, right? So this is supposed to be indicative more than anything else. But both of your points are well taken. It is case by case, but Juser, I think a lot of people will understand when you say that 1 year is a fair enough time frame for a fund manager to correct course if they're going wrong, and the kind of degree of underperformance is quite significant. I'm just wondering, among the various parameters that you would look at, I also wanted to discuss down capture ratio, because we've broadly seen an uptick for the benchmark apart from since August, right, where you've seen quite a bit of a crack because of foreign institutional selling. But in any given year, over a longer period of time, would you pay attention to down capture ratio? Because some people have suggested in research that fund managers who have managed to have a better down capture ratio, which is basically falling less than the benchmark, as compared to an up capture ratio, which is rising more than the benchmark in an up cycle, are better off in the long term. What do you think?
You want me to answer, right?
Yes, please, Juser.
So I think you cannot look at down capture ratio only in isolation. So I think one needs to look at the down capture ratio as well as the up capture ratio. And if the up capture ratio, and it's like basically saying that if the 100 index is rising by 100, and if the fund is rising by 140%, so he's performing better than the index, right? So you should take the up capture ratio, divide by the down capture ratio, and if he is more than one, then at least he is doing a better job, because just trying to saying you also want the fund to perform better. So just not look at the downside, but also the upside. So you need to look at it from both angles, not just look at the down capture ratio. So that's what I actually say.
Suresh, quick last point. Juza's point is you take the up capture ratio divided by the down capture ratio, it's more than 1, and that is a positive sign. Is that something that you will attribute to all schemes?
No, I think it's a very fair point that user is making. The down capture ratio can be actually low. I mean, I'll make that case with an example which you have flashed from the screen,
Yes.
which is Magnum Mid Cap Fund. Okay, so Magnum Mid Cap Fund is actually coming at the top of your list. But the point is, I mean, this is a fund that has not performed as well as the other similar funds in the category. Like for example, if you look at Motilal Oswal, it's a outperformer in the category. Okay, so the point is, I mean, if you have been choosing certain sectors or certain themes which are not going to fall that much, like for example, consumer durables and kind of thing, you may have a low down capture ratio, but at the same time, the upsides may not be that much. So we have to definitely look at the up capture as well as down capture, and the ratio which user mentioned, I think, is an appropriate ratio for us to look at.
Fantastic. Suresh, Juza, thanks so much for joining in for this very engaging conversation. Pleasure having you on the show.
Thank you. Thank you.
All right, let's shift base now away from mutual funds and talk about Capital Infra Trust, which is coming out with a 1,578 crore IPO. My colleague spoke with the management about how the company plans to utilize those funds, and here's what they had to say. Listen in.
Capital Infra Trust is actually a road InvIT platform, right? So we are launching an InvIT with around 9 assets to start with. All these assets are hybrid annuity assets, right? And the other sovereign party counterparty is National Highway Authority of India. So those are the 9 assets we'll be putting as a part of the initial piece of it. And going forward, we have a ROFO arrangement with the sponsor where we'll be adding further more assets.
Give us a sense of the fund use that is going to be there, because you are raising around 1,077. There is an OFS of 501 crores, which I think will go to the sponsor. But the 1,077 crores, what will be what is it going to be used for?
Yeah, so the fresh issue of 1,077 crores will have 2 aspects to it, right? The first, it will be reducing the bank debt, and the second, it will be actually used for repaying the company sponsor loan. So that will be, and the third aspect will be for some from expenses, right? For the InvIT expenses are there.
Give it a sense of the kind of debt which is there in this InvIT, and will the entire debt be repaid by this issuance?
Yeah, so I think so. As per InvIT regulation, right, you need to have a minimum 49% of leverage to start with, right? So we are proposing to have a leverage around 43%, right? And the debt will be refinanced immediately after launch through NCDs, right? Which we have already captured the OD of a document, right? And then the leverage will be brought down to 43% from the current levels.
So what will be the total debt the entire assets will have, the InvIT will have?
So we are targeting around, we are target, after the issue, we are targeting a debt around 2,400 crores.
Okay. Sir, give us a sense of the kind of cash flows which are going to come from these 9 assets, which are primarily HAM assets.
Yeah, so see, actually, in case of HAM, right, one of the best advantage is that there is no construction risk as such, right? And there are 3 aspects to the HAM asset, the revenue that comes, right? One is that it comes from interest on the principal annuity piece. The second is the annuity payment, and third is the O&M payments, right? So those are the 3 components that we get from the NHAI, right, as a revenue source, right? And then, of course, you have expenses and the interest payment to be made. So it's more or less a predictable and stable cash flow over a period of time.
Mm-hmm. You know, my understanding is, and you can correct me here, that NHA pays interest on the declining balance which is there, which is, I think, SBI rate plus 300 basis points. And as the entire payment comes down on a declining balance, the revenues also come down. I can see that from the projected revenues which you have given for FY 25, 26 and 27, where you're looking at 1,044 as revenue, and then it's coming down to 686 crores. So how do you plan to ensure that the revenues stay maintained?
No, so I think so that's the structure of the transaction and how the concession agreement designed, right? It's an amortization schedule that is a part of the concession agreement, right? So basically, whenever the annuity is paid, right, on the balance amount, the interest is charged, right? So just like a normal amortization schedule, right? So you'll see a revenue dip, right? But that's the structure that is there, right? And as we add more and more assets, right, we'll ensure that the cash flow remains stable and predictable for a long period of time. Because InvIT is a perpetual instrument, right? It's not only for the 9 assets that you are creating an InvIT, right? It's basically a growth instrument and it will continue to grow with the new asset being added, right? So I think at some point of time, you'll see the revenue being at the same level, right? Not getting impacted with the amortization piece of it.
How do you, finance the remaining future assets, which is, I think, if I'm not wrong, 17 new assets, and all of them, I think, are HAM assets. So how will you finance those?
So we have multiple strategies around that part of it. It can be through debt, also it can be through partly debt and partly equity also. So we have to start thinking on those lines, right? But I think so we are planning on the next level of acquisition. As and when it will be ready, we'll be able to give more colors to that.
This 17 assets, by when do you expect to acquire? And since it's a ROFO, will you acquire all 17, or it's going to be a part of that?
Yeah, these 17 assets will be acquired over a period of time, right? Considering the InvIT regulation, right? Where there's a 2.5 years of construction period and then 1 year of a completed revenue generating asset, right? Post that will be acquiring that part from the sponsor, right?
And how many of those assets are in operational stages?
We have a size. Yeah, so as currently we have 2 PCOD which have received, right? And we have other under construction asset, right? And thereafter, there are certain which are construction yet to start. But I think so we have a good pipeline in terms of the growth piece, and this is only from the sponsor piece. But we'll also be going to the third-party market and acquiring assets which are value accretive to the unit holders.
Okay. Sir, since it's a special structure or special asset, a separate asset class, InvITs and REITs normally go by the distribution income. What is the kind of yield that you're offering to the investors?
Yeah. Well, I can't disclose this, but I think so all InvITs are on the similar range, right? I think so there are natural hedge between a debt and equity, right? So of course the return will be around more of a double-digit kind of a return basically on the InvITs.
This is the annual distribution which will happen, is it?
No, it will be around minimum 2 distributions in a year because we are a public InvIT, but we have a provision to do quarterly distributions also.
Okay, and what will be the quantum of the distribution or yield that will come as part of the distribution?
So I think that's already disclosed in the OD document, right? So at this point of time, I can't speak more than that. But I think, as I told you, it's a natural hedge between a debt and equity instrument, right? So I think so the return will be much better, right? And I think so InvIT offers a better, tax optimized structure, right? So that's another advantage where, all investors, people who are paying taxes, they have a much better advantage in this case rather than any other instrument.
Okay. Just want to check, get a idea on the portfolio which you have currently. All your 9 assets are HAM assets. Your ROFO assets are also HAM assets. Is there a plan to go for other assets which are on a BOT basis so that you have a better streaming of revenues coming in?
Yeah, so I think so we have started with HAM, but I think so diversification will happen. And as things progresses, I think so we may look at BOT, right, third-party acquisition or from sponsors building that, right? But I think so there's a long way ahead, I think so, and we are here committed to grow the InvIT and develop the InvIT. So I think so that is definitely a part of a plan.
Also give us a sense of the entire road project sector as a whole. What is the kind of tendering that has come in? Because I just want to get an idea of the industry and how road tendering is taking place. What is the kind of tendering that has taken place in FY25 so far, and have you bid for, or the sponsors have bid for any of the tenders?
Yeah, see, I think the last year has been a bit slow, right, because of the elections part of it. But I think now it's picking up, right? And government has released around 54 projects on BOT, right, of 2 lakh crores, basically, right? So there's a bidding process that's starting now. I think so we'll see more development happening this year, basically. But I think so India has the largest second network in the world, right? India is the second largest network in the world, road network in the world, right? So the potential of growth on road and highway sector is huge compared to the other infrastructure sectors if you look at it. And in India, if you look at, there are 11 InvITs only in road sector currently, right? And than any other sector, right? So there's a lot of potential. I think the government is working, the policies are very favorable, right, for growth of it, right? So I think overall it's a very good sector to be in, and InvIT will flourish in this sector basically.
You know, one of the key risks that is there in ham-based InvITs is that if the interest rate regime goes down or it reduces, you know, it also reduces the outflow from NHI because their interest payments also reduce, and that way your income also comes down or revenue comes down. How do you plan to hedge that kind of interest rate differential or interest rate risk which is there?
Yeah, but if you look at it's a natural hedge, right? Because if your interest rate goes down, I think your cost of debt will also go down, right? So I think so to that extent you can naturally hedge that part from 50%, right? But of course, yes, there will be ways and means to develop the cash flow, and as you grow, right? I think so that should be a natural part of the process basically.
All right, that brings us to the end of this particular edition of the show. Thanks so much for watching. Do stay tuned. Lots more coming up over the course of the day. This is NDTV Profit.